Friday, April 20th, lbarnes reporting here. No politics this week, except to note that as the newsletter nearby opens, in any other year in the last half century, at this moment in the Fed's operations, financial markets, politicians, civilians, the housing sector would all be hanging right on the windowsill to watch what they're up to, except there is so much smoke and fog billowing out of other branches of government that nobody's paying any attention. This week, every sign in the markets says that the Fed's tightening moves have begun to bite. Until now, there's this long period of the Fed saying we're coming, and didn't. It was a bad series of crying wolf, although they're doing the best that they can. The Fed began to raise the overnight cost of money clear back at the end of 2015. I mean, it's 2.25 years ago. And it took them almost a year and a half to get to 0.75%. And they are now 1.75, with a promise to be at 2.25 by the end of this year. And you can see in the relationship between that overnight cost of money and long-term rates, to include mortgages, that the Fed is now pushing up long-term cost of money. Now, long-term rates all the time move with inflation. They tend not to move with the Fed. Sometimes they go up, sometimes they go down, no matter what the Fed is up to. Now, we don't have any change in inflation. We have the continuous expectation that inflation is going to rise to the 2% mark at some point, but it hasn't even done that. So the rise in long-term rates, mortgages now 4.75, headed for 5, most likely and soon, is entirely the work of the Fed. And we can tell because the Fed's interest rate is getting closer and closer to long-term rates. Now, all good children will be reminded endlessly in the next couple of years ahead that whenever short-term rates rise above long, we have a recession. We're not there. The 2-year T-note is still 0.5% below the 10-year T-note, but that spread has now come in by half just since January. And that's the marker that the Fed is pushing up. I am a fan of the Fed, card carrying, no matter how annoyed my friends are with the thought. I'm a believer in the place. They are flying exceptionally blind. The leading indicators that the Fed usually have are not behaving the way that they used to behave. And we're stuck as a species, certainly as financial markets, with looking backwards at markets to see what they did given certain inputs. And in the last half dozen years, there's nothing that's behaving the way that it ought to. So the Fed is on a funny kind of hair trigger, although moving up gradually. If something really changes, like inflation going up, wages going up, it's going to have to move faster. If, on the other hand, it continues to move gradually this way and nothing happens, it may wake up some morning and realize that it's gone too far. We're in exactly that situation. But the period of time of the last almost 2.5 years of the Fed just coming up from nothing to something, you mark the calendar, April 2018, this was the moment when they went from that initial adjustment to actually doing something material. And we're all going to feel it. We'll live through it. It'll all be fine, but we're going to feel it. Have a good weekend.